everyone, welcome back to my channel EduPath Class 10. In this video lecture, we will cover the chapter Money and Credit. So let's begin. Now, the money as the medium of exchange. We already know that money is a very large part of our everyday life, and it is used to buy and sell goods, exchange of service for money. And in some cases there might not any actual transfer of money but a promise to pay money later. Have you ever wondered why transactions are made in money only? The reason is very simple. The person holding money can easily exchange it for any commodity or service that he or she wants. Thus, everyone prefers to receive payments in money and then exchange the money for the things that they want. Let us understand the case of shoe manufacturer. He wants to sell shoes in the market and buy wheat. The shoe manufacturer will first exchange shoe that he has produced for money and then exchange the money for wheat. Imagine how much more difficult it would be if the shoe manufacturer have to directly exchange shoes for wheat without the use of money. He would have to look for a wheat growing farmer who not only wants to sell wheat but also want to buy shoes in exchange. That is, both parties have to agree to sell and buy each other commodities. This is known as double coincidence of wants. Now, how were transactions done in the older days? By barter system. It is a medium in which goods or services are exchanged directly without a common unit. It is also known as double coincidence of wants. What a person desires to sell is exactly what the other wishes to buy. In a barter system where goods are directly exchanged without the use of money, double coincidence of wants is an essential feature. Difficulty with the barter system is that only that conflicting wants are there, hence exchange becomes impossible. In contrast, in an economy where money is used, money eliminates the need for double coincidence of wants. Everyone prefers to receive payments in money. So, modern form of money. We have seen money in something that acts as a medium of exchange and transactions. Before the introduction of coins, a variety of objects was used as money. For example, since the very early ages, Indians used grains and cattle as money. Then thereafter came the use of metallic coins, gold, silver, copper. Then evolution of money, cow to gold, gold to metal coins, metal coins to paper money to plastic cards, then electronic money, then cryptocurrency. There are two forms of money: currency and deposits plus check. Currency are paper notes and coins. Currency. The modern currency is without any use of its own. Unlike the things that were used as money earlier, modern currency is not made of precious metal such as gold, silver and copper, and unlike grain and cattle, they are neither of everyday use. Then, why money is accepted as a medium of exchange? It is accepted as a medium of exchange because the currency is authorized by the government of the country. In India, the Reserve Bank of India issues currency notes on behalf of the central government. As per Indian law, no other individual or organization is allowed to issue currency. Then the law legalizes the use of rupee as a medium of payment that cannot be refused in settling transactions in India. No individual in India can legally refuse a payment made in rupee. Hence, the rupee is widely accepted as a medium of exchange. Now, deposits with banks. The other form in which hold money is as deposits with banks. At a point of time, people need only some currency for their day-to-day needs. Then what do people do with their extra cash? They deposit it with the banks. Banks accept the deposits, and in this way, money is saved with the banks and it earns an amount as interest. People also have the provision to withdraw the money as and when they require. Now, demand deposits. Since the deposit in the bank's account can be withdrawn on demand, these deposits are called as demand deposits. Demand deposits often another interesting facility. It is a facility which lends it the essential characteristics of money. The demand deposit accepted widely as a mean of payment along with currency. You must remember the role that the bank play here. But for banks, there would be no demand deposit and no payment by check against these deposits. The modern form of money, currency and deposits are closely linked to the working of modern banking system. Now this is a format of the check. And now what is check? It is a paper instructing the bank to pay a specific amount from person's account to the person on whose name the check has been issued. Let us try and understand how check payments are made and released. Now, a shoe manufacturer has to make payment for the leather supplier and write a check for the specific amount. This means that the shoe manufacturer instructs his bank to pay the amount to the leather supplier. The leather supplier takes his check and deposits it in his own account in the bank. The money is transferred from one bank account to another bank account in a couple of days. The transaction is complete without any payment of cash. Now, what do the bank do with the deposits which they accept from the public? Bank keeps small proportion of their deposits as cash with themselves. Example, banks in India holds about 15% of deposits as cash. Why? Kept as provision to pay the depositors who wants to withdraw deposited money at any time. Since on any particular day only some of its many depositors come to withdraw cash, the bank is able to manage with the cash. Now, where does the rest of the deposited money go? The rest of the deposited money is used by banks to extend loans to the people. There is huge demand of loan for economic activities. In this way, banks mediate between those who have surplus funds and those who are in need of funds. The difference between what is charged from borrowers and what is paid to the depositors is their main source of income. Now, two different credit situations. Now, first we have to know what is credit, what is loan. Credit or loan is the same thing. It refers to an agreement in which the lender supplies the borrower with money, goods or services in return for the promise of future payment. Okay, then let us see the two examples. Positive roles. Salim, a shoemaker, took loan to meet the expenses for a big order and promised to repay it. At the end of the month, Salim is able to deliver the order, make a good profit and repay the money that he had borrowed. In this case, Salim obtained credit to meet the working capital of production. Okay, then the credit helps him to meet the ongoing expense of production, complete production on time and thereby increases earnings. Now, credit therefore plays a vital and positive role in this situation. Now let's see the negative role too. Swapna, a small farmer, took loan from moneylender to meet the expenses of cultivation. The crops failed last year and takes a fresh loan for cultivation. However, earning is not sufficient to cover the past loan and then she fell into a debt trap. Now in rural areas, the main demand for credit is for crop production. There is a minimum stretch of 3 to 4 months between the time when the farmer buys these inputs and when they sell the crop. Farmers usually take crop loans at the beginning of the season and repay the loan after harvest. Repayment of the loan is crucially dependent on the income from farming. In Swapna's case, the failure of crop made loan repayment impossible. She had to sell part of the land to repay the loan. Credit, instead of helping Swapna improve her earning, left her worse off. This is an example of what is commonly called as debt trap. Credit, in this case, pushes the borrower into a situation from which recovery is very painful. In one situation, credit helps to increase earnings and therefore the person is better off than before. In another situation, because of the crop failure, credit pushes the person into the debt trap. To repay her loan, she has to sell a portion of her land. She is clearly much worse off than before. Whether credit would be useful or not, therefore, depends on the risk in the situation and whether there is some support in the case of loss. Now, what are terms of credit? Every loan agreement specifies an interest rate which the borrower must pay to the lender along with the repayment of the principal. In addition, lenders may demand collateral against loans. Collateral means जो सामान गिरवी रखते हैं. Okay. Now, collateral is an asset that the borrower owns and uses this as a guarantee to the lender until the loan is repaid. Now, collateral may be land, building, vehicle, livestock, deposits with bank, anything it can be. If the borrower fails to repay the loan, the lender has the right to sell the asset or collateral to obtain the payment. Now, the document required: employment records, salary slip, collateral, mortgage asset, and past bank statements. Now, terms of credit: interest rate, collateral, and documentation requirement, and the mode of repayment together comprise what is called as the term of credit. The term of credit varies substantially from one credit arrangement to another. They may vary depending on the nature of the lender and the borrower. Loans from cooperatives. Besides bank, the other major source of cheap credit in rural areas are the cooperative societies. The members of cooperative pool their resources for cooperation in certain areas. There are several types of cooperation possible, such as farmers cooperatives, weavers cooperatives, industrial worker cooperatives, etc. Krishak cooperative functions in a village near Sonpur. It has 2,300 farmers as a member. It accepts deposits from farmer, and by putting these deposits as collateral, it obtains large loan from the bank. Okay. Now, this is the Krishna cooperative provide loans for the purchase of agricultural implements, loans for cultivation and agricultural trade, fishery loans, loans for construction of house, and a variety of other expenses. Sectors of credit: formal sector and informal sector. Formal sector are banks and cooperatives. Informal are the money lenders, traders, and employers. Informal are the relatives and friends. Formal sector: Reserve Bank of India supervises the functioning of formal sector. RBI monitors the banks in maintaining cash balance. RBI sees that the banks give loans not just to profit-making businesses and traders, but also to small cultivators, small-scale industries, to small borrowers, etc. Periodically, banks have to submit information to RBI on how much they are lending to whom, at what interest, etc. Then informal sector: no organization to supervise. They can lend at whatever interest they choose, and there is no one to stop them from using unfair means. Informal lenders charge much higher interest on loan. Higher cost of borrowing means large amount of borrowers goes to repay the loan, and then this could lead to the increasing debt and debt trap. Banks and cooperative societies need to lend more. Okay, and this will lead to higher income, and many people could then borrow cheaply. Then cheap and affordable credit is crucial for the country's development. Now, what does this all suggest? The formal sector still meets only about half of the total credit needs of the rural people. Thus, it is necessary that the bank and cooperatives increase their lending, particularly in rural areas, so that the dependence of informal sources of credit reduces. Then, while formal sector loans need to expand, it is also necessary that everyone receive these loans. Now, SHGs, self-help groups in rural areas especially. Why poor households are still dependent on informal source? Because lack of banks in rural areas, and getting a loan from a bank is much more difficult than taking a loan from informal sources. Absence of collateral. Loans from informal sectors are easy. They know the lenders and the lenders know the borrower personally, and hence they are often willing to give a loan without collateral. Then the borrowers can, if necessary, approach the moneylender even without repaying the earlier loan. However, the moneylender charges very high rate of interest, keep no records of transaction, and harass the poor borrowers. In recent years, people have tried out some newer way of providing loans such as SHGs, self-help groups that pool their savings. A typical SHGs have 50 to 20 members, and savings per member vary from rupees 25 to rupees 100 depending on the ability to save. And if the groups have the regular savings, it become eligible for bank loans. Loan is sanctioned in group's name and creates self-employment opportunities for the members. Also, it is the group which is responsible for the prepayment of the loan. Any case of non-repayment of loan by one member is seriously dealt with the other group members in the group. Because of this feature, banks are willing to lend the poor women when organized in SHGs even though they have no collateral as such. SHGs help borrowers overcome the problem of lack of collateral and get timely loans at reasonable rates. Now, why are SHGs the building blocks of organization of rural people? It is not only help women become financially self-reliant, but also provide a platform to discuss and act on a variety of social issues such as health, nutrition, domestic violence, etc. Most of the important decisions regarding the savings and loan activities are taken by the group members. The group decides as regards the loan to be granted, the purpose, amount, interest to be charged, repayment schedule, etc. Now, Grameen Bank of Bangladesh. It is one of the biggest stories in reaching the poor to meet their credit needs at the reasonable rates. Started in 1970s as a small project, Grameen Bank in 2018 had over 9 million members in about 81,600 villages spread across Bangladesh. Almost all the borrowers are women and belong to poorest sections. These borrowers have proved that not only are poor women reliable borrowers, but that they can start and run a variety of small income generating activities successfully. Now, summing up, we studied the modern form of money and how they are linked with the banking system. On one side are the depositors who keep their money in the banks, and on the other side are the borrowers who takes loans from the banks. Now there are a variety of formal sources and informal sources of credit. Terms of credit vary substantially between formal and informal sector. Currently, it is the richest households who receive credit from formal sources, whereas the poor have to depend on the informal sources. It is essential that the total formal sector credit increases. The poor should get a much greater share of formal loans from banks, cooperative societies, etc. Then the NCERT question, please solve them. Thank you for watching my video. Please like my channel and subscribe my channel.